All right, let's look at petty cash. So, anybody ever heard of petty cash? I know a lot of times in class I always hear students say, I have no idea what that is. So, petty cash is basically just a fund of cash that is physical cash that is kept on hand at a location because you never know when you have something to pay for that they don't accept a card or they're not going to wait for you to process a check and things like that. So petty cash is there for those small kind of things. So when we think about, what do we use petty cash for? It's going to be for if we have like postage or courier fees, repairs, small ones. We might need to get some supplies, things like that. But a basic way that we can control these cash disbursements is going to be through check, right? But we do have times when that's not possible. So that's why we have petty cash. So that's an exception to the rule. So it's small payments that we might need to make. And, again, it's to avoid the time and the cost of writing checks for those small amounts where you might set up a petty cash fund. So petty cash is going to be an account that's established in our journal system, and we're going to treat it as a cash account, but it is just separate cash that we pulled out of our bank, and we have the physical cash on hand. So we might need to go, we might have a small office and we need a light bulb. Well, we're not going to wait for a check to be cut for a light bulb, right? So petty cash could be used for that. And what happens is you're going to take that cash from the petty cash box. You're going to go buy the light bulb. You're going to bring back the receipt and any change. And at the end of the month, you're going to do the journal entries to show what expenses you had to pay for. And that way you can see how you should journalize them. So when we think about a petty cash system, the first thing we have to do is we have to establish it. So our cash account that we typically have, that's cash that we have in the bank. So we want to pull out specific cash that we're going to keep on hand in this petty cash box at our location. So to do that, we're going to process a check for the petty cash amount, and there's going to be someone that's in charge of it called the petty cashier. So in this example, they're establishing a petty cash fund of $75. So to establish the fund, again, it's treated just like cash. So we're putting cash, we're increasing petty cash. So we're debiting petty cash. We're decreasing the cash in our checking account because we're bringing it out of the checking account, putting it into petty cash. So we're going to credit cash. So this establishes the fund. And this allows us to have $75 that is written in a check. We take it to the bank, we cash it, we put that $75 cash into whether it could be into like a lockbox, it could be into a drawer, it could be a locked up envelope, it could be a separate cash register that's actually on hand just for petty cash. So our process to establish the fund is to debit petty cash and credit cash. Now throughout the month, we're going to be using that cash, right? So we have things that we had to pay for. And the examples they show here are that we had tile cleaning that we had to pay for. So maybe we had something sticky that was spilled on tile that we couldn't just wipe up. So we had to have someone come do it. And they charged us $46.50. They wanted cash then. So we paid them out of our petty cash fund. We also had to pay for merchandise that was delivered to us. It was $15.05 for us to pay for the shipping. Another one was we had to send a package to a customer, so we had a delivery expense of $5. And then we had to purchase office supplies that we couldn't wait in order to be placed at Staples and then delivered. So we're actually buying the supplies. Maybe we went to Walmart and bought a ream of paper. So the cost was $4.75. So these are all the expenses we had during that month. So if we started with $75 and we had $71.30 that we spent, then we should have the difference of $370 remaining in that fund. So we had $75 that we started with, we spent $71.30, we get the difference. That's how much cash should be left in that cash box. Then the petty cashier is going to summarize all of those payments that were made. They're going to, typically when the receipt comes in, you're going to write on the back of the receipt what it was for, the petty cashier probably will write what journal entry to make, whether you're going to debit, a miscellaneous expense or a delivery expense, office supplies expense, whatever it may be. And then at the end of the month, when we need to replenish the fund, because remember, we've spent that $71.30, so now all we have left on hand is $3.70. So we have to get it replenished or reimbursed to be $75 again. So to do that, we do a journal entry where we debit miscellaneous expense for the $46.50 from the tile cleaning, merchandise inventory for the freight that we had to pay for the $15.05, delivery expense for the package we sent to our customer of $5, and $4.75 office supplies expense for the Prima paper. We're getting a check cut from the cash account for $71.30. We're again going to go to the bank. We're going to cash it. We're going to put that cash back into our box. So now we start the next month with $75 in our box again. Now you may find that that $75 isn't enough. So we might have needed to increase it. If we had $75 that we started with and we got, to the middle of the month and we had used all of it, then we shouldn't wait till the end of the month to replenish it. We need to replenish it sooner. But we might decide, okay, well, maybe 75 on hand isn't enough for our company. So we need to increase that amount. So to increase petty cash, we're just going to debit petty cash for the additional amount. Remember, we had already set up petty cash for $75. So if we wanted to go from $75 to $100, we're just going to debit petty cash for the difference. So we debit petty cash for the difference of $25, and we're taking $25 out of our cash account. We're going to get a check cut again for $25, and that's going to bring that petty cash that we have on hand to a total of $100. Now, the reverse could happen too. Maybe you got to, the end of the month and you never even touched enough of it. You only used $30 of it. Well, then maybe you decide after a couple of months you don't need to have $75 on hand, because remember, that cash on hand, it's a risk to your business. It's a risk of losing that $75. So if you can decrease that risk by decreasing the petty cash account or what you carry on hand. So the example they show here is that we want to decrease it from 75 to 55. So we want to take $20 out of the petty cash that we have on hand and put it back into our checking account. So we're going to debit cash and we're going to credit petty cash. So that's how the basic part of it's going to be. Whether you want to increase or decrease it, we know how to establish it. We know how to replenish it. But just like any other cash handling, we could have errors. So we might forget to get a receipt for someone. We might give them too much cash. We might not get enough cash back. So we could have cash over and short in those, just like we could before in any other cash handling. So we will follow the same process. So if it's short, we're going to debit cash over and short. If it's over, we're going to credit cash over and short. So we know based on the receipts what it should be, and we know based on the cash on hand what we have left. If there's a difference between the receipts and what we started with, then that would be a shortage or overage that we have to account for with the journal entry. All right, so as we lead into a little bit more with banking, let's talk about some of the banking services that we're going to have before we go into the bank reconciliation. So basic bank services, when we think about having an account, a bank account, there are some things that we have to look at. So first of all, we're going to use a bank account as a secure place for our cash rather than keeping all of our cash at the office, because that's not safe. For our bank, for that bank account, they're going to have assigned signature cards, and that's just to let them know so they have a signature to compare it to when the checks are being written out, so that you can see, does the person that signed that check, does it match with the signature of those who are authorized to sign it, and that someone else didn't just sign their name. We're also going to be using deposit tickets to provide support for your deposits as you deposit money into your account. There should be some kind of a record that you get to keep that proves that you put money into your account. And then we're going to be using checks to provide authorization to pay money out of the account. We also have the option to set up a check to use electronic funds transfers, whether that's in or out. We can pay someone or we can receive payments electronically, and that's when the bank's going to know that information. We're going to see it come through in our bank statement. And then our bank statements are what we're going to review at the end of each month to make sure that we've accounted for the cash properly. This next slide shows you an example of what a deposit ticket looks like. Again, some banks may not use deposit tickets as much. I know credit unions don't have the standard deposit tickets. They usually just give you a receipt that shows that. But this is what a deposit ticket would look like. So when you're depositing the money, you're going to be listing how much cash you have, how many checks you have, a total. If you have more than one check, you're going to list them on the back individually so that you can reconcile each of those checks. Because remember, when people write checks, we always have the risk of them coming back as not cleared. And this deposit slip is going to serve as proof of your deposit. This is just an example of a check. Again, that's used to withdraw money from your bank. It's going to include who the company is, the company that's writing out the check. We're going to have a signature area of who's signing it, who we're paying it to, how much we're paying, and what bank it's from. Then we have the bank statement, where we're going to be able to see what transactions happened during the month. So we have the beginning balance that we started with. We're going to see all the checks that came in and the debits that happened, or the things that we paid out. And then we're going to see the deposits or the credits that we got. So remember, we talked about debits and credits, and we said banking and accounting terminology is a little different. And this is where we're going to kind of see them intersect a little bit. But then at the end, we're going to see a current balance. We're also going to see the transactions that are listed individually, so we can see all the details. Alright, our next video will start with the bank reconciliation, where we learn how to reconcile all the transactions that happened in the month. And we'll start in the next video. Thank you.